Yo, what's going on, guys? Cruisc here, and today I'm going to be teaching you guys fair value gaps, how to find them in price, as well as how to identify them and what they're used for. Before I actually get started, I just want to say I'm trying to speak a little bit slower because I have noticed some comments, and I've noticed myself that in the videos I do speak a little fast, so I'm trying to slow down my pace a little bit. So if I seem a little bit more calm or more less passionate, it's because I'm trying to speak a little bit slower so you guys can understand me. Let me know if this is a good pace that I'm at right now. But anyways, let's jump right into the video and learn what fair value gaps are. So before we actually get into the video, I just want to say this Notion template or whatever it is going to be in the description below. It's also in my Discord. So if you guys join the server and you go down and find Cruis's channel and you go down to note resources, it'll have my day trading notes, which is going to be this, and it's going to have all the stuff that I have for beginners, also as well as intermediate and advanced traders. And it'll also have my personal trading notes. So stuff kind of outside of ICT or more advanced concepts, such as like weekly and daily profiles, are also going to be in this one. So make sure to join the Discord, and you guys will be able to find this in my resources tab underneath my channel. But anyways, let's actually get into the video. So to be able to find the fair value gaps in this template, you want to click PD arrays and concepts / ideas. Then find beginner, click that, and then you go to fair value gaps and inverse fair value gaps under PD arrays, and now we're right here. So first off, what is a fair value gap? So a fair value gap is an area in which price has moved away or into an area with large volume causing a gap or imbalance. So it looks like this. So the first candle is low and the third candle is high, aren't going to overlap. So you see how they don't overlap into the second candle? This creates an imbalance or an inefficiency, or like a gap, you could say. So that's basically what this says right here. Is a fair value gap is a 3 candlestick pattern that shows the gap in between the top and bottom candle, leaving an imbalance in price. Like I already said, that's the best way to put it. If you look in this example, you can see you mark out the first candle's low to the third candle's high, and that's where the box goes, aka the fair value gap. Now we can look into price. So if you've seen from earlier, these are actually fair value gaps, and just so you guys know, there's going to be a bunch of fair value gaps, different sizes. As you can see, there's a ginormous fair value gap right here, and then if we go into if we keep scrolling a little bit, you'll see there's also little ones like this that you'll have to stretch your charts a little bit to be able to mark out. But you can see even they get tapped into. So there's different fair value gaps, different sizes, and there's also different ways of knowing which one to use and which one not to use. Okay, now I'm going to explain to you guys a simple concept called buying low, selling high. Why would we want to buy at a lower price? Let's say that I was to buy at the top of this move, right? And then let's say we take profit right here. Okay, we have our stop loss down here. Now let's say that we continued higher. We didn't pull back right here. So let's say price went directly to our TP. This is 26 points. Now if we were to pull into discount and we enter down here, right? Let's say we enter on discount, stop right there, and then we take profit at the same spot. Look how much more money we made. 63 points worth of profits versus 26 points of profit. That's why people say to buy the dips or buy the pullbacks, because your entry price is going to be lower, and then when price moves higher, you can make more money. So this is going to be the exact same thing in this entry. So in this trade, right, we see in the higher time frames, we see this breaker block right here. This 15-minute breaker block that gets pulled across. We see price respects it on this candle on the 11:15. So now we're going into after 11:15, zoom back in, and after 11:15, right? So 11:15 candle close. So this is the one that taps back into it. Then we get into 11:35 or 11:30. We get 2 5-minute candles above, and then we see we pull back once more with the sell side, as well as we're in a fair value gap. So we're in a 5-minute fair value gap that we're in. And now we're going to scale into the 1-minute chart. So our entry to go long, right? So we have 2 fair value gaps that are in discount of the range to go long, correct? And you can see in this example, we actually did tap into both. Now what I would do is, I would have put my entry as soon as we get into discount right here, right? And I put my stop down here. And then we target buy side liquidity, which you can see is the external range high. And you can see this would have hit TP. There's 2 different things you could have done. You could have either waited for this one, which is most likely to get filled, right? This entry is most likely to get hit and send us up. Or you could wait for the little bit more risky, better entry price, which would be the one down here, where you'd end up getting your order filled down there. And then you could see you have better RR, you have less stop loss, and more take profit. So what I used to do before was, depending on how much my stop loss was. So let's say I had like a 15-point stop loss, right? Obviously, if I was to put it up here, you can see I would have got entered into the price and then wicked out in the same move. So what I would have done was I would have moved my entry lower. I would have moved my stop loss lower so that I can have my 15-point stop loss at this low, and then my entry wherever I end up. But you do want to make sure you have this 1 minute fair value gap. And one thing that I would have been looking for immediately to close the position is if this body was to go through it, this would be bad news, because then that would mean that price is most likely to seek for this low, and that would be my stop loss, invalidating the trade. And that's also when I would have cut it. If I would have seen a body below this, let's say this is the body, right? And the fair value gap had a body through it, I would have closed the position, because that would mean that this fair value gap is no longer being respected and is being disrespected. So now I'm going to be teaching you guys what it means to respect and what it means to disrespect the fair value gap. So easiest way to remember this is you're looking at the bodies, where the bodies are. So you can see in this example, we have a fair value gap right here on this bullish candle. Then we get this bearish candle taps back into it, and we get a wick. The way to tell if this is respected or disrespected is if the body closes through the equilibrium of the fair value gap or through the entire fair value gap. So if it's a little bit smaller of a fair value gap, such as this one, and the body ended up going through the equilibrium, but not through the whole fair value gap, then I would be waiting for the next candle to see what that does. If the next candle closes through the fair value gap and there's no longer any wicks or respecting of this fair value gap, then I would look to close the position. Now, looking for a fair value gap that gets disrespected would be this example. We pull this across, you see we get a move down, we get a pullback, we wick it, meaning we respect this fair value gap, and then we go lower. Then we start to reverse, and instead of using this as support again, we end up pushing through it, creating bodies through this fair value gap. This is what disrespecting a fair value gap looks like. We have bodies through it, no longer validating this as resistance to go lower. That is the difference between a respected fair value gap and a disrespected fair value gap. So now you guys can see. If you guys want to take a picture of this, you guys can. If not, it is in my notes that I have in here. You'll see the inverse fair value gap is a disrespected fair value gap. Also, I have explanations of it. What does disrespecting a fair value gap mean? As you can see, we have a fair value gap right here. So if we have a bearish fair value gap and then a bullish candle pushes through it and creates a candle through that fair value gap bullish, that means that this bearish fair value gap is no longer seeking price lower, but it is seeking price higher, which is also invalidating this fair value gap to go lower. So now I'm going to be going over common mistakes that I see a lot of people taking. First is our narrative/trend. Where is the day expected to go, right? So if we're in a bullish trend, obviously you're going to want to be looking for bullish price action, meaning you're going to be looking for bullish fair value gaps. Now, this kind of goes hand in hand with our next one, is looking for bearish fair value gaps and bullish price action, vice versa. Let's say that our trend, right? Let's say our trend is bullish, right? And now I'm looking for a trade. Am I going to be looking for a bearish fair value gap in this price action right here? Or am I going to be looking for a bullish fair value gap in this price action here to go higher? Obviously, if our price action is bullish going up, I'm going to be looking for a fair value gap that I can use as support rather than resistance to go lower. Another thing that I see a lot of people fail on, and that's one thing that I failed on a lot, is small fair value gaps. So when you're looking at price action, what are the chances that a fair value gap of this size, right, holds rather than of this size holding? Right? Obviously, this fair value gap is probably more likely to get ran through because it's smaller and it means almost nothing. But if you have a huge fair value gap, like let's say this was news, and we have this ginormous fair value gap right here, price is more likely to respect this than this small one, because the small one is almost insignificant in price compared to something like this. So be wary, backtest it, see where you're taking your losses from, and usually, from my personal experience, it's been from these small fair value gap entries that I've been trying to take, as well as FOMO, which is leading into our last point. FOMO, trying to get into entries such as like this. Let's say that we're in a bearish trend and we start pushing down. You guys may have get this. We have a draw on liquidity right here. All right, and we're about to take it. Right, you try to get into a fair value gap like that and then go lower so that you can hit TP. But instead, price decides to push higher into a bigger fair value gap up here. Let's say that this is like the 5-minute time frame. Price decides to push higher into a fair value gap like this, and then we finally take out that draw. If you were to enter right here, first of all, you'd be getting clapped. Instead of hitting a 1-to-1, you'd be getting stopped out. Also, you're not in premium of the range, right? So if we want discounted premium, we want a premium PD array to then go short. So let's say we enter at the middle of this fair value gap and we put our stop up here. We target down here. Sell high, buy low. And look, 128 points. That's a 2.69 RR because you waited longer rather than entering short and taking a unnecessary loss that you didn't need to, simply because of FOMO. So that's going to be it for today's video. Hope you guys enjoyed. Hope you guys learned something new. Hopefully I taught you guys something new. I'm also going to be leaving this Notion journal in the actual description, as well as my Discord, in case you want any more resources trading wise, or if you want to talk to me personally. Let me know how this paste is. Leave it in the comments. Subscribe, like the video. Thank you guys for the subscribers and all the support recently. Appreciate it very much. And it's been Cruisc. Peace.